Now, many of you remember the 2008 financial crisis, which was largely triggered by the housing market bubble. Back then, the belief was that housing prices would just keep going up forever. Mortgages were given to people who couldn't afford them, and the financial system was flooded with complex debt products, all underpinned by these risky loans. The result? When the bubble burst, global markets tanked. The market dropped by over 50%, and the fallout was brutal, with 8.7 million jobs lost and the S&P 500 not fully recovering until 2013.
I want to just go back to 2008 for a moment and just even start with a very big picture sense of it all. What do you think happened that led to 2008?
Well, I think the main thing, but there's all kinds of tributaries feeding into the big Missouri River on this, but you had people think that housing could do nothing but go up, and you had a $20 trillion market in residential housing. So it was a big asset class, and people started using it as a currency, basically, and they found out that it wasn't straight up, in the end, and they borrowed on them, and there were levels of participation up and down the line. I mean, people at the top were writing mortgages that they knew they'd never have to hold, so they'd sell them to somebody in Norway after they'd been put in a package, and you had people refinancing, figuring that it didn't make any difference whether the monthly payments were too high, and you had them lying on loans, and you had the lenders participating in it, and you basically just had a huge speculation in housing, and 50 million of the 75 million owner-occupied homes in the United States were mortgaged. 25 million were free and clear, so they were okay. But you literally had a crash in the value of something that 50 million families owned on margin, had thought were going to go up. They'd based their living standards on it. In many cases, they'd borrowed against it. And it was unlike any widespread financial participation anybody had ever seen. So it manifested itself in all kinds of ways. I mean, everybody behaved badly, but they believed, and when people start believing something kind of crazy, you get that sort of thing.
It's early 2008. Hedge funds with a lot of subprime mortgages are going under. There were a couple. At that point, how worried were you? Do you remember being worried?
Well, I wasn't worried because I've always assumed that in a lifetime of participating in the American economy, it's going to move forward dramatically over time, and also it's going to have a lot of hiccups. And it's part of our economic system that we will periodically have some craziness go on, and so I don't try to predict markets, or I don't try to predict business. I just try to adapt to what comes along. I did see in the summer of 2008, I got a call from one of the top officials of one of the main Wall Street firms trying to sell us many billions of dollars worth of equity securities in Freddie Mac, and I knew something was wrong.
So take us back. I don't know if you remember this. This is after Bear Stearns goes down. So this is before Fannie and Freddie.
Yeah.
But after Bear Stearns, you get a call from Dick Fuld.
Right.
And he tells you that his stock is getting killed by short sellers.
Yeah.
And
when anybody says that to me, I get very suspicious. I'd love to have short sellers in Berkshire. How does a short seller hurt you?
And he says there's an opportunity for you to invest somewhere between $3 to $5 billion. Are you interested?
I'm interested in hearing him out. Yeah.
And what did you tell him?
I told him, tell me what your ideas are, and I'll do some looking at it. But tell me what you'll pay first. and then I'll know whether I want to do some looking. And so he threw out some tentative ideas. I do remember, and actually, he said, "Can I have Hank Paulson call you?" And so Hank called about, I think it was 6 or 7 on a Friday night, and then he stopped short of giving a totally unqualified endorsement, but he was probably hoping I was going to finance it, but he wasn't going to try and sell me too hard. I'm sure he didn't feel that was right. So anyway, I spent that evening going through there, probably a 10K. I've got it at the office still where I made notes as I went through it, and it was 250 or 300 pages, and I just wrote down on the front page the number of the pages where I was finding problems, and when I go through, I knew that it was not for us.
Because you saw what?
I just saw a lot of things that made me very worried about their financial condition and what would be happening to them under the circumstances that were happening in Wall Street.
Now we're in September of 2008. And this is Friday, September 12th. This is the weekend.
The weekend.
The weekend. And you get a call this time, not from Lehman Brothers, but from AIG, asking if you'd be interested in investing $10 billion in the company.
Yep. I said that, don't count on us. I know time is of the essence with you guys, so just don't waste it on me. So I'm out at that point. Now, they re-enter the picture a little later. But I said, I can't figure this thing out. It would have been 20-some billion dollars, and we could have paid it if I'd known what we were getting. Well, the very fact that they were calling me and sending out stuff Friday evening at 8 or 9 o'clock New York indicated they were in peril.
What does a call to Warren Buffett mean, you think?
Well, it means that they know we'll act fast if we like something. So we are the best fast buyer for anything that involves in the billions of just about anybody. And they knew I'm interested in the property casualty business in this particular case. And you know that they are desperate for something that's going to close within a few days.
So, how does 2008 help us understand 2024? Well, it's pretty simple. While in 2008 the problem was rooted in the overvaluation of housing, today we're seeing similar signs of overvaluation in tech giants, particularly in sectors like AI, semiconductors, and quantum computing. In the last couple of years, the market has thrown money at these industries, with companies like NVIDIA leading the charge in producing AI chips. NVIDIA, for example, has seen its stock skyrocket by over 3,200% in just 5 years. Investors are betting big on these sectors, just like they did on housing in 2008. AI-specific chips alone are expected to generate over $71 billion this year, and with heavy investment in generative AI models, tech giants have enjoyed incredible profits. However, there are growing concerns that this AI bubble could pop. Some investors are starting to fear a sharp correction, especially as competition intensifies and demand for AI-related products potentially cools down. Companies like Tesla, which had a market cap of over $1 trillion in 2021, could see sharp declines if investor sentiment changes. Similarly, speculative assets like cryptocurrencies have seen wild price swings that could collapse if confidence falters. So the question is, where should you invest in 2024, and what should be your investment strategy? Now, if you're familiar with Buffett's investing style, you know that he's seen his fair share of market bubbles and crashes, from the dot-com bubble in the late 1990s to the 2008 financial crisis, and more recently the COVID-19 crash in 2020. He's been a voice of reason during each of these times, and we can learn a lot from how he approached them. When Buffett talks about an overvalued market, he's typically looking at several key indicators. One of the big ones is the Buffett indicator, the ratio of total market capitalization to GDP. Historically, this ratio sits at around 100%. But when the dot-com bubble burst in 2000, that ratio spiked to 137%, signaling massive overvaluation. Fast forward to today, and in 2024, we're sitting above 150%, far exceeding even that bubble territory. To put it into perspective, the dot-com bubble in 2000 was at 137%, the 2008 financial crisis 105%, and today, in 2024, over 150%. This is one of Buffett's favorite tools to assess if the market is in dangerous territory. When this ratio goes up, it means that stock prices are becoming disconnected from the actual economic output. Investors are buying not based on fundamentals, but on speculation, something Buffett has always warned about. Let's talk about a similar situation, the dot-com bubble. During the late 90s, investors were throwing money into tech companies with sky-high valuations, even though many of these companies weren't profitable and had no clear business model. At the time, Buffett refused to get swept up in the hype. People thought he was crazy for sitting on the sidelines, but we all know what happened next. The bubble burst in 2000, and the Nasdaq fell by nearly 80% over the next 2 years. Buffett stayed cautious and waited for valuations to come back down to earth. That's classic Buffett. He doesn't chase overvalued stocks. He waits for the right price and sticks to businesses with strong fundamentals. Now let's look at what Buffett does in these overvalued markets. As I mentioned earlier, one of his biggest strategies is focusing on businesses with strong fundamentals, what he calls a moat. According to him, this is what an ideal business looks like.
The ideal business is one that earns very high returns on capital and can keep using lots of capital at those high returns. I mean, that becomes a compounding machine. So if you have your choice, if you could put $100 million into a business that earns 20% on that capital, say 20 million, ideally it would be able to earn 20% on 120 million the following year and 144 million the following year and so on. That you could keep redeploying capital at these same returns over time. But there are very, very, very few businesses like that. The really, unfortunately, the good businesses, take a Coca-Cola or See's Candy, they don't require much capital. And incremental capital doesn't produce anything like the returns that this fundamental return that's produced by some great intangible. So we would love the business that could keep deploying, in fact, even well beyond the earnings. I mean, we'd love to have a business that could earn 20% on 100 million now, and if we put $1 billion more in it, it would earn 20% more on that $1 billion. But like I say, those businesses are so rare. There are a lot of promises of those businesses, but we've practically never seen one. There have been a few. Most of the great businesses generate lots of money. They do not generate lots of opportunities to earn high returns on incremental capital. We can deploy X at C's and earn a lot of money, but if we put 5X in, we don't earn any more money to speak of. We can earn high returns on X at the Buffalo News, but if we try to make it 5X, we don't earn any more money. They just don't have the opportunities to use incremental capital. We look for them, but they don't. So you've seen, I mean, we will talk theoretically about the businesses that are going to earn more and more money with incremental capital at high returns. But what you've seen is that we've bought businesses largely that earn good returns on capital, but in many cases have limited opportunities to earn anything like the returns they earn on their basic business with incremental capital. Now, the one good thing about our structure at Berkshire is that we can take those businesses that earn good returns in their business but don't have the opportunity for returns of a similar magnitude on incremental money, and we can move that money around to buy more businesses. Normally, if you're take the newspaper publishing business, which has been a fantastic business over the years, you earned terrific returns on your own invested capital, but if you went out to buy other newspapers, you had to pay a very fancy price, and you didn't get great returns on incremental capital. But the people in that business felt that the only thing they knew was newspaper publishing or media of one sort or another, so they felt that their options were limited. We can move money any place that it makes sense, and that's an advantage of our structure. Now, whether we do a good job of it or not is another question, but the structure is enormously advantageous in that respect. We can take the good business, the See's Candy. See's has produced probably $1 billion pre-tax for us since Charlie and I wouldn't have gone up 100,000, back in 1972. If we tried to employ that in the candy business, we'd have gotten terrible returns over time. We wouldn't have gotten anything to speak of. But because we moved it around, it enabled us to buy some other businesses over time, and that's
He always looks for companies with durable competitive advantages, whether it's a trusted brand, economies of scale, or a technological edge that others can't easily replicate. Let's listen what he says about Apple.
The next question comes from Eli Amin Tibet, who asks, during an episode of Investing the Templeton Way podcast, Professor Damodaran, who he respects almost as much as Warren and Charlie, mentioned that he is not comfortable with positions becoming a large part of his portfolio, for example, when they reach 25 to 35%. He mentioned that Apple is now 35% of Berkshire's portfolio and thinks that that is near a danger zone. Wonders if Warren and Charlie can comment.
I'd like to make one comment first, but Charlie will come up with...
I think he's out of his mind.
Yeah, I knew that was coming. But Apple is not 35% of Berkshire's portfolio. Berkshire's portfolio includes the railroad, the energy business, Garanimals, you name it, See's Candy. They're all businesses. And, the good thing about Apple is that we can go up. They buy in their stock, and instead of owning 5.6%, they got about 15 billion, 700 and some million shares outstanding. They get down to 15.25 billion without us doing anything. We got 6%. So we can't own more than 100% of the BNSF. We can't own more than 100% of Garanimals or See's Candy. And it'd be nice. We'd love to own 200%, but that just isn't doable. But they're all the same. They're good businesses. And to think that our criteria for Apple is different than the other businesses we own. It just happens to be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad. And Apple is a better business. Our railroad is a very good business, but it's not remotely as good as Apple's business. Apple, has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own 100% of, but we're very, very, very happy to have 5.6 or whatever it may be percent, and we're delighted every 0.1% that goes up. It's like adding $100 million to our earnings. I mean, our share of the earnings, and they use the earnings to buy out our partners, which we're glad to see them sell out too. The index funds have to sell if they bring the number of shares down. And we went up slightly last year, and I made a mistake a couple of years ago, and I sold some shares when I had certain reasons why gains were useful to take that year from a tax standpoint. But having heard me say that, it was a dumb decision. Charlie, you've already given your comment about it, but we do not have 35% of Berkshire's portfolio. Berkshire's portfolio is the funds we have to work with. And we want to own good businesses, and we also want to have plenty of liquidity. And beyond that, the sky's the limit, or our mistakes, who knows what the bottom is.
For example, during the 2008 financial crisis, while many investors were panicking and selling off their stocks, Buffett was quietly making massive investments in companies like Goldman Sachs and Bank of America. These companies were fundamentally strong, but were selling at a discount because of the overall market crash. By 2010, his $5 billion investment in Goldman Sachs yielded a profit of over $3 billion. That's how Buffett operates. He waits for fear to drive prices down, then he pounces.
Let's start off and talk about the economy a little bit. And obviously, we've been on a good long run here.
A very long run.
And yet, does that surprise you? And what would be the signs that you would look for to see that things were winding down?
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers. so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses, what those numbers tell me. They're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year. We care a lot about the price. We do not care about the next 12 months.
But are you surprised at how long this economy has been expanding?
I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if you go back and read Keynes or you read Samuelson, you read any of them, they do not get into a negative rate environment. I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom on a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic, even if the price was right.
All right, so you don't pay much attention to the dismal scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. You may know he was a big shareholder of Berkshire, but it's, they make guesses, and there's so many variables. I mean, in the hard sciences, you know that if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
This 2024 market is fueled by an abundance of cheap money. For years, low interest rates have encouraged borrowing and risk-taking. But with rising inflation concerns, we've seen central banks hike rates to control prices. That could lead to a situation where highly leveraged companies, ones that borrowed heavily when money was cheap, struggle to pay back their debt. Buffett's advice here is simple. Only when the tide goes out do you discover who's been swimming naked. This is one of my favorite Buffett quotes because it perfectly describes what happens in an overvalued market. When money is flowing freely, everyone looks like a genius. But when conditions tighten, weak companies with too much debt get exposed. This is what he has to say about the risk of leverage.
Leveraged up investments in just common stocks. And you'd figured a way so that you would have staying power if there were any market dip, I mean, you'd obviously have obtained extraordinary returns. I pointed out in my investing lifetime, an index fund would do 11%. Well, imagine how you'd have done if you'd leveraged that up 50%, whatever the prevailing rates were over time. So a leveraged investment in a business is going to beat an unleveraged investment in a good business a good bit of the time. But as you point out, the covenants to protect debt holders have really deteriorated in the business. And of course, you've been in an up market for businesses, and you've got a period of low interest rates. So it's been a very good time for it. My personal opinion is if you take unleveraged returns against unleveraged common stocks, I do not think what is being purchased today and marketed today would work well. But if you can borrow money, you can buy assets that will yield 7 or 8%, and you can borrow enough money at 4 or 5%, and you don't have any covenants to meet, you're going to have some bankruptcies, but you're going to also have better results in many cases. It's not something that interests us at all. We are not going to leverage up Berkshire. If we'd leveraged up Berkshire, we'd have made a whole lot more money, obviously, over the years. But both Charlie and I probably have seen some more high IQ people, really extraordinarily high IQ people, destroyed by leverage.
Look at 2020's recovery. The stock market shot up by more than 40% in a matter of months, fueled by government stimulus and low interest rates. However, in 2024, those companies that overextended themselves during this period of easy money may now be at risk. Buffett's advice for times like these? Stick to what you know. Don't get tempted by flashy, overhyped stocks. His portfolio is largely made up of companies like Apple, Coca-Cola, and Kraft Heinz, businesses that produce real goods and services with stable cash flows. Finally, let's talk about cash, a big part of Buffett's strategy that we often overlook. As of Berkshire Hathaway's most recent reports, Buffett is sitting on a whopping $130 billion in cash. That's not because he's scared or unsure about the market, it's because he's waiting for the right opportunities. When the market is overpriced, Buffett isn't afraid to sit on the sidelines, even if it means missing out on some short-term gains. Why? Because he knows that at some point, prices will come back down to more reasonable levels, and he'll be ready to buy. This is especially relevant in 2024. With so much uncertainty around inflation, interest rates, and global instability, Buffett is playing it safe. Having that cash reserve gives him the flexibility to jump in when others are running for the exits. So what should we take away from Buffett's strategy for 2024? First, recognize that the market might be overvalued right now, just like it was in 2000 and 2008. But that doesn't mean you have to panic or sell everything. Instead, focus on companies with strong fundamentals, avoid speculative assets, and keep some cash on hand for future opportunities. As Buffett likes to say, it's better to be approximately right than precisely wrong. So take a step back, focus on the long term, and don't get caught up in the hype. If you found this video helpful, make sure to hit that like button and subscribe for more investing insights. And drop a comment below. Do you think we're in a bubble? How are you preparing for 2024? I'd love to hear your thoughts.